Channel trading systems. Prices often flow in channels, the way rivers flow in valleys. When a river touches the right edge of its valley, it turns left. When a river touches the left rim of its valley, it turns right. When prices rally, they often seem to stop at an invisible ceiling. When they fall, they often seem to hit an invisible floor. Channels help traders identify buying and selling opportunities and avoid bad trades. Channels parallel to trend lines are useful for long-term analysis, especially on the weekly charts. Channels around moving averages are useful for short-term analysis, especially on daily and intraday charts. Channels whose width depends on volatility are good for catching early stages of major new trends. Support is where buyers buy with greater intensity than sellers sell. Resistance is where sellers sell with greater intensity than buyers buy. Channels show where to expect support and resistance in the future. A channel's slope identifies a market's trend. When a channel lies flat, you may trade all swings within its walls. When a channel rises, it pays to trade only from the long side, buying at the lower wall and selling at the upper wall. When a channel declines, it pays to trade only from the short side, shorting at the upper channel wall and covering at the lower wall. When prices rise above the average consensus of value, sellers see an opportunity to take profits on long positions or go short. When they overpower the bulls, prices decline. When prices fall below the moving average, bargain hunters step in. Their buying and short covering by bears lift prices, and the cycle repeats. When prices are near their moving average, the market is fairly valued. When prices are at or below the lower channel line, the market is undervalued. When prices are at or above the upper channel line, the market is overvalued. Channels help traders find buying opportunities when the market is cheap and shorting opportunities when the market is dear. The market is like a manic depressive person. When he reaches the height of mania, he is ready to calm down, and when he reaches the bottom of his depression, his mood is ready to improve. A channel marks the limits of mass optimism and pessimism. Its upper line shows where bulls run out of steam, and its lower line shows where bears become exhausted. Every animal fights harder closer to home. The upper channel line shows where bears have their backs against the wall and fight off the bulls. The lower channel line shows where bulls have their backs against the wall and fight off the bears. When a rally fails to reach the upper channel line, it is a bearish sign. It shows that bulls are becoming weaker. If a rally shoots out of a channel and prices close above it, it shows that the uptrend is strong. The reverse rules apply in downtrends. Channels help traders who use them remain objective when others get swept up in bullish or bearish hysteria. If prices touch the upper channel line, you see that mass bullishness is being overdone, and it is time to think about selling. When everyone turns bearish, but prices touch the lower channel line, you know that it is time to think about buying instead of selling. Amateurs and market professionals handle channels differently. Amateurs bet on long shots. They tend to buy upside breakouts and sell short downside breakouts. When an amateur sees a breakout from a channel, he hopes that a major new trend is about to begin and make him rich quick. Professionals trade against deviations and for a return to normalcy. It is normal for prices to remain within channels. Most breakouts are exhaustion moves that are quickly aborted. Professionals like to fade them, trade against them. They sell short as soon as an upside breakout stalls and buy when a downside breakout stops reaching new lows. Breakouts can produce spectacular gains for amateurs when a major new trend blows out of a channel. Amateurs occasionally win, but it pays to trade with the professionals. Most breakouts are false and are followed. by reversals.